If you're running a business, you know that cash is everything. But what if the capital you need for that next big growth spurt isn't about finding a new investor? What if it's already sitting in your workshop or warehouse? Well, today, we're going to show you how to unlock it. Let's dive in.
So, does this sound familiar? You've got the vision, you've got the orders coming in, the drive is there, but the cash, it's just tight. It feels like you're being held back, especially with the way the economy is these days.
But what if I told you the answer isn't out there somewhere? That the money you need is right there, on your own balance sheet, kind of hiding in plain sight. It's time to find that capital that you already own.
So here's our game plan. We'll start with how to actually fund your growth using stuff you already own. Then, we'll get into the nitty-gritty of using your assets as collateral. After that, we'll answer the million-dollar question. What are your assets really worth? Then, we'll cover how to get the absolute best deal. And finally, we'll talk about smart strategies that go way beyond just getting a loan.
You know, sometimes it feels like getting capital from the big banks is, well, an impossible climb. They can feel like these giant gatekeepers. But what if there was another way? Another path to get the funding you need for growth, one that doesn't depend on a traditional loan officer saying yes or no.
So what is this other path? It's called asset-based financing. And it's actually pretty simple. It's just a loan that's secured or backed up by something valuable you already own, your assets. This gives the lender a safety net. If, for whatever reason, things go south and you can't pay back the loan, they have a claim on that asset. It's a win-win, really. You get the cash you need and they get peace of mind. Okay, so how is this really different from a regular loan? Well, think about it like a mortgage on your house. The house itself is the collateral, the security for that huge loan. Asset-based financing is the exact same idea, but for your business. That piece of machinery, that pile of inventory, that's your house.
And when we say asset, what are we actually talking about? Well, you might be surprised. It can be your inventory, the stuff you sell. It can be your accounts receivables. That's the money your customers owe you. Of course, machinery and equipment. Even property, customer invoices. Basically, a whole bunch of valuable things that are already on your books.
All right, so you've got a list of your assets. Now for the practical part. How does a lender look at, say, a forklift or a truck and turn that into a specific loan amount in dollars and cents? The key number you need to know here is the loan-to-value ratio, or LTV. Now, lenders are pretty cautious, right? So they're not going to lend you 100% of what your asset is worth. They build in a little buffer for themselves, a margin of safety, just in case prices drop. That's why you'll usually see them offer somewhere in the ballpark of 60 to 80% of your asset's total value.
Let's make this super clear with a quick example. Let's say you have a piece of equipment that gets appraised for $100,000. The lender comes in and says, okay, we'll do an 80% LTV. You just do the math. 80% of $100,000 is $80,000. And the 80 grand, is the maximum loan you can get using that machine as collateral. It's that simple. Okay, so that LTV thing makes sense. But this all leads to the most important question of all. How in the world does a lender decide what your equipment is actually worth to begin with? It turns out there's not just one answer. There are a few different ways to value something.
First up, you've got fair market value, or FMV. This is basically the best case scenario. Think of it as the price you'd get on a good day when you're not in a rush to sell and you find a buyer who's not in a rush to buy. Everyone's happy, everyone's informed. That's fair market value.
Now let's turn up the heat just a little. That brings us to orderly liquidation value, or OLV. In this case, the seller has to sell. The clock is ticking. But they still have a reasonable amount of time to find a decent buyer. It's not a fire sale, but it's not a casual sale either.
And then there's this one, forced liquidation value, FLV. This is the rock bottom number. This is a fire sale. Imagine a quick auction where you need the cash like yesterday. As is, where is, going once, going twice, sold. And here's the kicker. A lot of banks use this FLV number when they're figuring out your collateral because it's their absolute worst case scenario.
Okay, enough with the theory. We get how it works. Let's talk about what you can actually do. How do you navigate all this stuff to make sure you're getting the best possible financing deal for your business?
Now, you might be thinking, hey, I'm putting up valuable collateral. My personal credit score shouldn't matter that much, right? Wrong. It absolutely 100% matters. A strong credit score tells lenders you're reliable. It's your ticket to getting better terms and a higher LTV. On the flip side, a weak score can mean tighter rules and less money, even with great assets.
And of course, the wider economy has a big say in all this. When interest rates are high, your monthly payments are going to be higher. It's just simple math. Lenders also tend to get a little more nervous. They might be stricter about older equipment or look extra hard at your cash flow. But here's a little pro tip for you. Even putting a small down payment on the table can make you look like a much safer bet and help you lock in a better rate.
So where do you actually go to get this financing? Well, you've got options. Big banks, they often have the best rates, but let's be honest, they can be a tough nut to crack for smaller businesses. Credit unions are fantastic. They know the local community. And then you have alternative lenders. They're often way faster and more flexible, especially if your credit isn't perfect, but you might pay a little more in interest.
Listen, if you only take one piece of advice away from this, please let it be this: shop around. Do not, I repeat, do not take the first offer you get. Talk to at least 2 or 3 different lenders. Make them compete for your business. It is the single best way to know you're getting a fair deal.
All right, let's zoom out for a second. Getting a loan isn't just about getting a check and calling it a day. It's a strategic move. So let's look at how you can fit this piece of the puzzle into a much bigger, smarter financial plan for your company.
Here's a really clever way to use this kind of financing: debt consolidation. If you're juggling a bunch of different debts, credit cards, other small loans, you can use one asset-backed loan to pay them all off. Suddenly, you have just one monthly payment to worry about. This usually lowers your total interest rate, frees up your cash flow, and hey, it can even help your business credit score in the long run.
And here's another pro move: pairing your loan with a business line of credit. Think of this as your company's financial safety net. It's a pool of money you can dip into whenever you need it for unexpected costs or to cover those gaps between paying your own bills and getting paid by your customers. For seasonal businesses, this is an absolute game changer.
And that really brings us to our final question. I want you to think about this. You work incredibly hard every single day to build your business, but are your assets working just as hard? By understanding asset-based financing, you can put every single part of your business to work for you, unlocking the capital that's been there all along.